A faint hum of fluorescent lights filled the narrow conference room, the kind of place where brilliant ideas were born and catastrophes were quietly constructed. At the center of the polished wooden table sat a man whose calm confidence bordered on unsettling. He had the kind of presence that made even seasoned financiers sit straighter in their chairs. His colleagues called him a visionary, though not always with admiration. Some whispered that he could see patterns in markets no one else could, others insisted he simply believed the numbers would obey him out of respect. He never corrected them. He preferred to let people assume he understood the world more deeply than they ever would. Outside, Manhattan buzzed with its usual electricity, but inside this room the air felt still, almost heavy. A new venture was forming, an investment firm unlike anything the financial district had seen before. The idea was simple on paper: gather the brightest minds, combine their mathematical brilliance, and build a machine that could outthink the market. But the simplicity was deceptive. Beneath the elegant aspirations lay an unspoken belief shared by everyone at the table, that if intelligence could be weaponized, this group was about to prove it. All they had to do was trust in the models, trust in each other, and trust that the world would behave the way it always had. At the head of the table, the founder adjusted his glasses and surveyed the room. He was no stranger to pressure. Years earlier, he had stumbled onto a peculiar trading pattern that seemed almost too good to be true, an inefficiency that repeated itself with uncanny predictability. That discovery had changed his life, but it also altered the way he saw risk. To him, risk wasn't something to fear, it was something to quantify, measure, and tame. Watching him now, one might mistake his steadiness for humility, but his composure came from certainty. Not arrogance, at least not yet, but the kind of certainty that grows in someone who believes numbers don't lie. Across from him sat a former professor whose reputation stretched far beyond academia. His entire career had been built on understanding the behavior of prices, why they moved, and how to predict them before anyone else even noticed a tremble. He had spent decades turning uncertainty into equations, and the investment world had come to revere him for it. Joining this team wasn't a career move for him, it was an opportunity to see his theories tested under real-world pressure. The glint in his eyes betrayed a curiosity that couldn't be satisfied in lecture halls. Here, in this room, he had the chance to watch the markets bend, or snap, under the weight of mathematical precision. Next to him, another scholar leaned forward in his chair, tapping a pen against his notebook. He was younger, less reserved, and carried the restless energy of someone who saw finance as a puzzle to be conquered. He talked quickly, thought even faster, and treated every trading idea like a problem set waiting for the right solution. To him, the biggest danger wasn't risk, it was boredom. And this new firm promised anything but. If someone had asked him whether he feared the markets, he would have laughed. Fear, in his opinion, was for people who didn't understand probability. The rest of the room was filled with traders who had spent years navigating chaos on trading floors where shouting was a form of currency. They were talented, fearless, and in some cases, dangerously competitive. What united them wasn't ideology or loyalty, it was the shared belief that they were about to build something immortal. Something the rest of Wall Street would envy. They didn't say it aloud, but the unspoken message lingered between them: the old rules no longer applied. With enough intelligence, creativity, and capital, they could write new ones. The founder clicked a pen and began outlining the plan. They would use a strategy built on convergence, patterns in pricing that always corrected themselves over time. If two financial instruments were mispriced relative to each other, the gap between them would inevitably shrink. That was the theory. And if the theory held, the profits would be extraordinary. But the real key wasn't the strategy itself, it was scale. They wouldn't rely on small, cautious trades. No, they would amplify every opportunity with leverage, turning modest gains into astonishing returns. The model suggested the risk was minimal. The team believed the models. For now, at least, that was enough. As he spoke, the room seemed to pulse with possibility. There was a sense that they stood on the edge of something historic. They weren't building just another investment firm, they were constructing a machine powered by intellect and precision, a place where intuition took a back seat to mathematics. And yet, somewhere deep beneath the excitement, there lingered a shadow they chose not to acknowledge. Markets were human creations, driven by emotion as much as logic. But no one in the room wanted to think about that. Not yet. The meeting stretched on for hours as they refined the structure, debated the mechanics, and assigned responsibilities. Eventually, the founder leaned back in his chair with a quiet satisfaction. Everything was in place. The team was assembled, the strategy was polished, and the early investors were waiting. They were ready to launch. The room fell silent for just a moment, as if everyone sensed that they had crossed an invisible threshold. When they finally stood and gathered their papers, a few exchanged excited glances. Others kept their emotions guarded. But every single person in that room felt the same thing, a rising heat beneath the calm surface, a spark of ambition that could either illuminate the financial world or burn straight through it. No one could yet imagine how far that spark would spread. No one could predict the storm that lay on the horizon, but the first step had been taken, and the story, one of brilliance, miscalculation, and the unforgiving nature of markets, had only just begun. The first few months unfolded with an almost cinematic smoothness, the kind of beginning that convinces a team they were destined for greatness. Every morning, long before the sun reached the Manhattan skyline, the office lights glowed like a beacon of ambition. Analysts arrived clutching coffees the size of small fire extinguishers, flipping on their monitors to find the world precisely as they had predicted it. Prices moved in the patterns the models described. Spreads tightened exactly when expected. The equations behaved as if they were guiding the market itself. And each time a trade closed in profit, confidence deepened like roots sinking into the earth. Numbers rolled across the screens in soft neon colors, greens for gains, reds for losses, though the reds were rare. Each successful trade reinforced the same intoxicating belief: they had cracked a code that Wall Street had been trying to decipher for decades. Even the skeptics on the team found themselves swept into the momentum. Something extraordinary was happening, something that defied the usual chaos of finance. Logic ruled. Patterns held. And the returns emerged with machine-like precision. The founder moved through the office with a calm that bordered on prophetic. He rarely raised his voice, never celebrated too loudly, and kept a small notebook tucked in his jacket pocket filled with tidy, handwritten observations. He spoke of statistical destiny and market correction the way a surgeon talks about anatomy, confident, practiced, certain. He often reminded the team that the strategy worked because it was grounded in reality, not emotion. If they stayed disciplined, the markets would reward them. And for a long stretch of time, the markets seemed eager to agree. Of course, the brilliance of the operation didn't go unnoticed. Word quietly spread among elite investors, whispers about a firm producing returns that made even seasoned hedge fund veterans raise their eyebrows. Big institutions began sending representatives to Manhattan to evaluate the team, hoping to gain even the smallest invitation to invest. They sat stiffly in conference rooms, pretending to understand the complex mathematical explanations while really evaluating the confidence in the team's eyes. And confidence, at that stage, was something they had in abundance. More money flowed in, and with it came larger opportunities. It felt as though every success unlocked the door to an even larger one. The models could handle bigger positions, the traders said. The strategies scaled beautifully, the quants insisted. And with each reassuring presentation, the firm expanded its reach further across global markets. Soon, they weren't just analyzing mispriced government bonds, they were monitoring subtle pricing imbalances across continents. Europe, Asia, emerging markets. Nothing escaped their gaze. Inside the office, the culture shifted. Meetings felt less like discussions and more like confirmations of brilliance. Challenges were met with polite nods, then dismissed with data. The younger traders, once cautious, began to adopt the same quiet swagger the senior members carried. They weren't reckless, they would have bristled at such a suggestion, but they were certain. Certain the models accounted for every scenario. certain human irrationality could be smoothed out with enough statistical rigor. Certain that they, collectively, were smarter than the market, yet beneath the surface of this confidence was a subtle pressure none of them acknowledged openly. Large investors expected consistent returns. The prestige of the team demanded perfection. And the models, though powerful, needed constant adjusting to keep pace with changing conditions. At night, some analysts stayed late, pretending they were simply dedicated, when in truth they were attempting to silence the nagging fear that maybe, just maybe, no model could predict everything. Still, each morning brought fresh confirmation that their fears were unnecessary. The world continued cooperating. Prices converged. Volatility remained tame. The firm's calculations danced in harmony with reality, but markets have a way of lulling even the sharpest minds into a false sense of security. The more predictable things appeared, the more unpredictable they were about to become. Late one evening, after most of the team had left, the founder stood alone by the window, staring out at the glittering city below. A stack of reports sat on his desk behind him, each filled with projections that painted a picture of endless growth. But a single line from a conversation earlier that day kept replaying in his mind. One of his partners had mentioned an unusual shift in trading volumes overseas. Nothing alarming, just unusual. He told himself it was meaningless noise. The model said everything was fine. The data said everything was fine. But the longer he stared at the city lights, the more he realized something he would never admit aloud. He couldn't shake the feeling that the world was changing in ways the equations hadn't predicted. He exhaled slowly, pushed the thought aside, and turned off the office lights. For now, the success continued. For now, the team still believed their brilliance was unshakable. For now, the world still made sense, but the cracks had begun, thin, nearly invisible lines forming beneath the surface of a flawless machine. They just didn't know it yet. The turning point did not arrive with the drama anyone expected. There was no sudden crash, no headline blaring warnings, no urgent notification demanding immediate action. Instead, the shift crept in quietly, like a faint tremor beneath a city, too subtle to shake buildings, but enough to unsettle the ground if you stood still long enough to feel it. It began with slight distortions in markets that normally behaved with mechanical precision. Spreads that should have tightened drifted instead. Prices that historically mirrored each other began wandering apart like siblings who no longer spoke. At first, the anomalies seemed harmless. Every system generates noise. Every model tolerates deviation. But the deviations kept multiplying. Inside the firm, the atmosphere remained outwardly confident. Meetings were still filled with calm voices and polished charts, each decorated with neat trendlines reassuring investors and employees alike. The founder reassured the team that fluctuations were temporary. Markets would correct themselves soon, just as they always had in the past. And for a time, the team accepted that explanation. After all, they had lived years watching the formulas deliver results precisely as promised. If there was ever a moment to give the models the benefit of the doubt, this was it. But late-night conversation started to take on a different tone. Analysts lingered near the coffee machine analyzing the day's unusual price action. Junior traders exchanged uneasy glances when senior partners dismissed their concerns a little too quickly. The quants spent long hours adjusting their simulations, searching for a variable they might have overlooked. And though they publicly insisted everything was fine, privately they began to notice a pattern that unsettled them deeply. The market wasn't simply deviating from expectations, it was rewriting them. One morning, a sharp move in an obscure foreign bond jolted the team into a rare moment of collective silence. The price hadn't just moved, it had jumped in a direction no model predicted. When the founder walked in and saw the traders staring at their screens, he paused. The room felt different. Tense. Heavy. A senior analyst cleared his throat and stated, with unusual hesitation, that the anomaly didn't fit any scenario they had accounted for. The founder listened quietly, then responded in the same steady tone he always used, "Markets occasionally behave irrationally. This was temporary. It would correct, but the correction didn't come. Instead, the anomaly spread, echoing across continents. Prices drifted in synchrony, as though some invisible force had nudged entire markets off their rails. A few team members suggested scaling back positions until the turbulence passed, but that idea was met with hesitance. Scaling back meant admitting uncertainty. Admitting uncertainty meant accepting that their models were fallible. And accepting fallibility would undermine the very foundation of the firm. Meanwhile, the pressure from investors intensified. They wanted answers. They wanted reassurance. They wanted the same returns the firm had always delivered. Investors had placed their trust not just in the strategy, but in the intellect of the team, a belief that brilliance alone could outmaneuver chaos. And the team, perhaps subconsciously, felt compelled to validate that trust. If they hesitated now, they feared they would look weak or unsure. So they doubled down, convincing themselves that larger positions would amplify profits once the markets returned to normal. To justify their decisions, the quants reran their models with updated data. The founders stood behind them one afternoon as the simulations flickered across the screen. The new calculations suggested that the probability of large losses had actually decreased. Risk, according to the numbers, was lower than before. This made little intuitive sense, but the math was clean, logical, elegant. It was everything the team wanted to see. They accepted the results without questioning the flaw hiding beneath the surface. The models were being fed data from distorted markets, and distorted inputs lead to distorted predictions. The sense of invincibility returned, artificial, fragile, but powerful. They expanded their positions further, stretching their leverage to levels that would have made their earlier selves hesitate. The firm was now exposed to hundreds of interconnected trades across numerous countries, all based on the assumption that prices would eventually converge. But convergence requires stability, and stability was slipping like sand through clenched fingers. Then, without warning, a major bank overseas announced it was dissolving a portion of its trading division. The decision seemed sudden and unrelated to the firm's activities, but the effects rippled instantly. Large positions were liquidated, volatility jumped, and spreads widened violently. Markets panicked. Prices swung in erratic, exaggerated arcs. Screens across the office lit up with losses that multiplied by the hour. The reaction inside the firm was swift and desperate. Traders shouted commands into phones. Analysts recalculated exposures with trembling hands. Even the seasoned partners exchanged looks that betrayed something they had never shown before: fear. The founder remained composed, though his voice grew quieter as the day progressed. He urged everyone to stay focused, to trust the models, to avoid emotional decisions. But the room no longer listened with the same steady confidence. They heard him, but they also heard the market screaming in the background. By the end of the day, the losses were staggering. More concerning was the realization that they could no longer unwind their positions. The markets were too chaotic, the buyers too few, the spreads too wide. Each attempt to exit only worsened the situation. They were trapped inside a machine of their own design, one that had grown too large and too interconnected to escape. That night, the founder remained in the office long after everyone had left. He walked the dimly lit trading floor slowly, surveying the empty chairs, the abandoned coffee cups, the screens still glowing with red numbers. The weight of responsibility settled on him with a heaviness he had never felt before. For the first time, he admitted to himself, quietly, reluctantly, that the models he trusted so deeply might not be able to save them. Outside, the city continued its restless pulse, unaware of the storm gathering within those walls. That he knew the next chapter would decide everything. The next morning arrived with a deceptive calm. The sun rose on schedule. Traffic flowed normally. The world continued as if nothing extraordinary had happened. But inside the firm, the tension was thick enough to bend steel. Employees filtered in with stiff expressions and hollow eyes, many having slept only a few hours. If they slept at all, the founder was already there, sitting at the head of the long glass conference table, staring at a set of overnight reports. His posture was still upright, still composed, but something in his expression had changed. He looked older. Not physically, but in the way someone looks when they've finally acknowledged a truth they spent months avoiding. As the leadership team gathered, the screens on the walls displayed a real-time feed of global markets. Red dominated every chart. Bond spreads widened further. Liquidity was evaporating. Several institutions across Europe and Asia had halted their trading desks. Everything that depended on stability was buckling one piece at a time. The risk officer spoke first. His voice carried the tremor he tried, and failed, to suppress. Overnight losses were far worse than projected. Their leverage had magnified every shock. If markets continued in this direction, the firm would no longer meet its margin requirements by the end of the day. Silence followed. The founder tapped the edge of his pen against the table, a slow, deliberate rhythm. What options do we have? He asked. The head of trading exhaled sharply, truthfully. Very few. We can attempt a controlled unwind, but the liquidity just isn't there. If we push too hard, we'll crash our own positions. Another voice chimed in. There's also the possibility of seeking emergency financing. But after the last 24 hours, no lender will take on this risk without posting insane conditions. Someone else suggested hedging, but the team shot it down immediately. Hedging required functioning markets. These markets were no longer functioning, they were convulsing. The founder's eyes remained fixed on the data. And if we do nothing? A brutal answer. Then we lose everything. Slowly, but completely. The room was sinking, morally, emotionally, financially. A junior analyst, seated near the back, broke the silence. There's something else, he said softly. The models, they're behaving erratically. When the inputs get this distorted, the outputs lose coherence. We're calculating probabilities that don't make mathematical sense anymore. Everyone turned toward him. He swallowed. The model isn't broken. It's just blind. It can't see what's happening out there. The founder nodded slowly. He already knew. He had seen the numbers twist into impossible shapes the night before. He understood that the elegant machine he built had reached the edge of its map. Finally, he stood, slowly, quietly, with deliberate control. We built our strategy on the assumption that markets might bend, but they would never break. Today, they are breaking. His voice remained calm, but the emotion behind it was unmistakably real. Our job now is not to win. It's to survive. The team exchanged glances. Survival sounded almost foreign to a firm that had only ever spoken in terms of dominance and precision and mastery. The founder continued. We will reduce positions, carefully, gradually, in every region. No hero trades. No doubling down. We act with discipline. And if the market gives us an exit window, even a small one, we take it. Orders were issued. Teams scattered. Phones lit up in every direction. Traders negotiated desperately for liquidity that barely existed. The firm's positions began to unwind, not smoothly, but with surgical restraint. Hours passed. On some screens, losses slowed. On others, they worsened. The process was agonizing, like trying to escape a collapsing building while the floors fell away in random intervals. By noon, they received their first piece of good news. One of their largest counterparties had agreed to absorb a part of the position, at a painful price, but at least it was movement. Shortly after, a second window opened. Then a third. Momentum shifted just enough for the founder to feel a flicker of hope. Not certainty. Not safety. But possibility. Then, mid-afternoon, the alert came. A major hedge fund, one far larger than theirs, had just declared insolvency. Markets reacted instantly, violently, catastrophically. Every chart in the room plunged. Liquidity vanished once again. Whatever fragile progress they had made evaporated in seconds. The founder closed his eyes. He realized then that survival would not be a matter of strategy or intelligence or probability. It would be a matter of courage, of what choices they were willing to make when the numbers finally stopped providing answers, and the numbers had stopped. The announcement of the hedge fund's collapse spread through the financial world like a shockwave. Within minutes, news anchors were scrambling, analysts were speculating, and global markets were spiraling into a fresh wave of panic. But inside the firm, the reaction was quieter, far quieter. It wasn't the loud, chaotic panic of amateurs. It was the suffocating silence of experts who understood exactly what this meant. The founder stood still, hands pressed flat against the table, staring at the waterfall of red numbers on the main screen. Losses cascaded faster than the team could process them. Phones rang unanswered. Models froze. Data feeds lagged. The market had entered a state where even information refused to behave. The head of risk spoke first, his voice barely above a whisper, "This is it. We're in a full systemic unwind." The words hit like a physical blow. A systemic unwind meant the rules had changed. All correlations, all the patterns the firm relied on, all the mathematical relationships that had held markets together for decades, they weren't bending anymore, they were snapping. The founder knew this scenario. He had modeled it years ago hypothetically, back when the firm was small and cautious. In those simulations, the outcome was always the same: catastrophic losses. Back then, it was merely a theoretical edge case. A black swan. The kind of scenario so unlikely that no one believed it would ever occur in reality, but theoretical nightmares were now walking into the room. "Sir," a trader approached carefully, holding a sheet of fresh printouts. His hands shook. "We've lost another 7% of our global portfolio in the last 6 minutes. The founder didn't ask for charts or explanations. He didn't need to. He had the full picture painted across every screen in the office. Markets weren't declining, they were collapsing in layers. A bond market froze. A currency pair spiked uncontrollably, commodity spreads widened to historic extremes. An ETF halted trading entirely. Losses fed losses, instability fed instability. It's like the entire system is unraveling," someone whispered. As the chaos deepened, the team did what they were trained to do: adapt. Traders attempted to hedge exposures, even though hedging tools were failing. Analysts reran stress tests that produced readings so negative they looked fictional. Assistants reached out to counterparties, only to be met with voicemail greetings or silence. Then something unexpected happened. A senior quantitative researcher, a quiet, reserved mathematician named Dr. Hale, stepped forward. She held a binder full of old simulation logs. "I need to show you something," she said. Everyone gathered around as she opened the binder to a section labeled Model Integrity, Extreme Stress Scenarios. "These simulations were run when we first designed the system," she explained. "Back when we tested what happens if spreads explode globally, and correlations flip across all asset classes." The founder remembered the tests. Back then, they had dismissed them as intellectual exercises. She pointed to a line in the simulation summary: "When volatility surpasses this threshold, the model can no longer provide guidance. It effectively enters a blind zone." And, the founder asked, "We're in that blind zone now. Deep in it. The model has no predictive power here. It's reading noise as data." The room fell into a different kind of silence, one filled with realization. "If the model is blind," one analyst whispered, "then we've been making decisions using broken vision." Dr. Hale nodded. "That's why our hedges aren't behaving. That's why the risk projections don't make sense. The system can't interpret markets in this state." The founder took a step back, absorbing her words. He had crafted the firm's identity around the brilliance of its models, around the certainty of mathematics, around the idea that intelligence could conquer randomness. But today, randomness had teeth, and intelligence was bleeding. "What do you recommend?" he asked quietly. Dr. Hale took a breath. "We go manual." The room froze. Manual. A word that felt ancient, primitive, reckless. Human. Manual trading meant relying on judgment rather than equations, instinct instead of probability distributions, experience over simulation. No one in the firm had operated manually at this scale. They were engineers of data, not old-world traders from the days of chalkboards and ticker tape, but the alternative, the current path, was certain death. The founder nodded slowly. "All right. We go manual." Orders were restructured. Algorithms were shut off. Automated triggers were disabled. Every trade from that moment forward would be placed by human decision, not machine logic. The atmosphere shifted. Fear was still there, but something else emerged: focus, the kind of sharp, battle-ready focus that only arrives when people are stripped of everything except raw survival. Screens flickered, phones lit up, hands steadied, voices grew firm. The founder watched his team transform from quants into warriors. For the first time in the firm's history, the machines stepped aside, and the humans took control. Outside, the markets continued to convulse. Inside, the fight for survival had just begun. The shift to manual trading felt like stepping into a storm without instruments. Every price tick, every market halt, every sudden spike carried the weight of irreversible consequence. But for the first time in days, there was clarity, not from certainty, but from accepting uncertainty. The team moved with tense precision. No algorithms, no auto-execution, just people, judgment, and real-time intuition. The founder stood at the center of the trading floor, not as a commander issuing perfect instructions, but as the anchor keeping everyone steady. His voice was calm, measured, and human. Each decision was debated, examined, and executed with surgical intent. For a brief stretch, minutes, maybe an hour, the strategy worked. They exited a cluster of positions in Asia before another freeze. They hedged a volatile currency pair just in time to dodge a sudden 4% swing. They negotiated a private block trade with a counterparty who demanded a brutal discount but provided desperately needed liquidity. Small victories, tiny breaths of air in a collapsing atmosphere, but no one believed salvation had arrived. Everyone felt the market's weight pressing harder, like a tidal wave gathering strength far offshore. By late afternoon, a chilling message arrived from their clearing bank. Margin requirements had doubled. A collective exhale spread across the room, not panic, not shock, but resignation. Margin calls of that magnitude meant one of two things: sell now or be force liquidated later. And force liquidation meant extinction. The founder ran a hand across his face and looked at the screens. Thousands of numbers, all trembling in a global quake. He had built a fortress of elegant mathematics, but the storm outside was tearing through equations as if they were tissue. He walked to the glass window overlooking the city. Cars moved normally. People crossed streets unaware. The world outside seemed almost disrespectfully calm. He returned to the desk. Prepare for the full unwind, he said. No one argued. No one hesitated. Orders were sent. The final liquidation began. Positions that had taken years to build unraveled in minutes. Some sold at decent prices, most sold at painful ones. A few simply vanished into the void of frozen markets. The models that once guided them were silent, just grids of dead numbers. The only sound now was the steady tap of human fingers placing trades that marked the end of an era. Losses accumulated like a rising tide, unstoppable but finite. And then, finally, as the last major position was closed, something unexpected happened. The screen stopped bleeding. The red didn't turn green, it simply stopped spreading. The downward spiral flattened into stillness. They were out, bruised, battered, nearly broken, but out. The founder sank into his chair, letting out a long breath he had held for days. Around him, his team did the same. Some wiped their eyes. Some stared blankly at the screens. Some smiled weakly, not in celebration but in sheer exhaustion. The firm had survived, not victorious, not unscathed, but alive. Later that night, with the office mostly empty, the founder stood alone again, watching the city lights shimmer below. He knew the cost had been enormous, financially, emotionally, philosophically. The empire he'd built on unshakable logic had encountered a storm large enough to show its limits, but he also knew something else. The failure wasn't the models. It was believing the models were infallible. Markets could break, systems could blind, and sometimes, survival required not brilliance or certainty, but humility. He powered down the last glowing monitor. Tomorrow, the rebuilding would begin. Not with perfect equations, but with wiser minds. For now, he stepped out into the quiet night. Breathing the fresh air of a world that was still standing. The storm had passed, and the next chapter, whatever it would become, belonged to the future.